Hey everyone, Adam Bergman, tax attorney for IRA Financial, and really excited to talk about the basics of IRA taxation and IRA investment rules. So I obviously have a law degree. I even have a master's in taxation, worked at some of the largest law firms in New York, and it always frustrated me how I never took one class or learned really anything about IRAs. And seems kind of crazy, right? 3 years of law school, an extra year, master's in taxation, worked on a lot of interesting matters from a taxation standpoint, private equity, corporate stuff. Not once did I ever learn about IRAs. And IRAs are super important. Why? It fuels our retirement system. There's 53 million IRAs, right? Over $11 trillion in retirement money. Okay. And it's the most powerful way that we can save for retirement. Also based off federal income tax code, right? So it applies to all of us, no matter if you live in New York or Texas or Alaska. The retirement system is a U.S. national system and it works. I always say it's the one area where there's bipartisan support, whether you're Democrat, Republican. It's the one thing that they all agree on across the aisle. Why? Because it's based off simple math, which we'll see and learn about in a few minutes. And it works because it's based off numbers. And it's really frustrating when I talk to other attorneys or friends or colleagues, and they don't understand what an IRA is or a Roth IRA is or a SEP IRA, and understanding the potential fuel that we could have to boost our retirement savings. It's literally a golden ticket that the government's giving all of us to supercharge our retirement. So hopefully in the next hour or so, we talk about all the different IRAs, and I can hopefully give you a sprinkling of knowledge that you can use to help yourself, help your family, and take advantage of this golden ticket because it works. It just takes time. But based off the system of tax deferral, compounding interest, your money grows faster when it's not subject to tax. And that's why I really love the retirement system. As a tax lawyer, it excites me because it works and your money grows faster without tax. And some of the basic principles of being a tax attorney is you want to defer or eliminate tax. And the retirement system, especially IRAs and Roth IRAs, can do that. So without further ado, let's get right into it and have some fun here. So the history of IRAs. Pretty much before 1973, Employee Retirement and Income Security Act, ERISA, there was no such thing as IRAs. People generally saved through defined benefit plans. Actually, 401ks were also born through ERISA. So unless you worked at really, really large companies that had what's called defined benefit plans, which were actually super expensive to run, big companies, governments, local municipalities, police force, things like that would have these DB plans, which would provide you a defined benefit, as you work and for retirement. And that was it, really. There was no such thing as any individual mandate to save for retirement. So ERISA is super important because it created this system for IRAs and even defined contribution plans, incentivizing us to save. We like to spend, right? America, the best country in the world. We are spenders. So obviously government was concerned going back in the 60s and 70s that, hey, the U.S. population will not have enough when they retire, and they will ultimately become a burden on us. So we all know about Social Security and some of the burdens it has in terms of funding, and they were concerned that there would not be enough money that Americans would have to have a fruitful retirement. So they created ERISA, and they want to incentivize us by saving. And in order to incentivize us, they did a couple things. And this is really the foundation of the traditional IRA and the 401k. Is number one, they gave us a tax deduction for contributions. So you reduce your taxable income when you make contributions. And they included the tax deferral arrangement, where your money grows without tax. So those two principles is what fueled the growth in the U.S. retirement system. 53 million IRAs approximately as of 2021, over $33 trillion in the retirement system. So most people's wealth are tied into IRAs. Okay, there's over 480 billion or so of rollovers from 401ks to IRAs each year. So it's very important to get comfortable with what an IRA is. And unfortunately, not enough of us understand it. About 60% of Americans have retirement savings. That's it. And that's just unacceptable. We can do better. The fact that I never knew that you could use your IRA to do alternative assets like real estate as a lawyer, as a tax lawyer, someone who's worked at large law firms is embarrassing. Okay, and that's kind of what fueled me to start my company, IRA Financial, is to help and educate people about the U.S. retirement system, the power of IRAs, and also what the tax code offers. So that's what I really wanted to focus on today and spend a lot of time educating all of you about the different types of IRAs, some of the basic rules, contributions, distributions, and then go into some of the really cool investment options. So what is an IRA? Really, the term IRA is used to describe an individual retirement account, broader category of individual retirement arrangements. Basically, it's a trust. Okay, it needs to be opened at a bank, financial institution, or regulated trust company like IRA Financial Trust. You can't open an IRA at Walmart. So it needs to be either through a bank like Wells Fargo, a financial institution like Schwab, or a regulated trust company. Okay, why? Because we have regulatory responsibilities and we need to provide and offer certain custody and administration features that only regulated institutions can provide. Okay, so that's it. It's really an IRA could be an arrangement or an annuity. So who's eligible to make IRA contributions? Okay, this is broadly. You need to have earned income. Okay, so if you're retired, just play golf all day or just hang out, you don't have any compensation for income, 1099, self-employment income, W-2, you may not be able to make contributions to an IRA. You still may be able to fund an IRA through rollover, which we'll talk about shortly. But in order to open an IRA and fund it, you need to have earned income, which again is compensation for services, 1099, self-employment income, W-2. Passive income does not count. So if all you have is capital gains, dividends, royalties, rental income, interest, you can't use that to make contributions to an IRA. Social Security, disability, no good. Okay, so that's number one. You must have earned income, okay, to start an IRA. Now, you can potentially piggyback off a spouse. So what that means is if you do not have any earned income, but your spouse has earned income, at least $6,000 or $7,000, which is the limitations for 2021, you can piggyback off your spouse's income and make your own contribution. So if your spouse made $40,000 and you don't work, and you're under 50, you can contribute $6,000. Since you do not have your own earned income, but your spouse does, you can piggyback off your spouse's income and make a contribution into an IRA, even though you do not have earned income. The only other way to fund an IRA is through rollover, which I mentioned close to $500 billion a year are rolled over from 401ks or defined benefit plans or 457s, 403s to IRAs. Okay, so those are the two ways you can fund an IRA: contributions through earned income or rollovers through another retirement account. Okay, and as I mentioned, there's 53 million IRAs approximately. Most are invested in traditional investments like stocks or mutual funds. 11 trillion plus in IRAs and close to 33 trillion in retirement funds. So it's a big, 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 big industry. Let's start with the most popular IRA, right? The traditional IRA, it's a pre-tax IRA. It's born out of the 1974 ERISA Act, and it became popular based off the Economic Recovery Tax Act of 81, which started increasing the amount you can contribute to an IRA. In 2021, the most you can contribute to an IRA is $6,000 if you're under 50, $7,000 if you're over 50. Again, you need to have that in earned income. It cannot be passive. It must be earned. Okay, compensation 1099 W-2. The deadline to make contributions for a prior year, so for 2020, the deadline is May 17th, 2021. Generally, it's April 15th, but because of COVID, it was extended a month. So in 2022, the deadline to make contributions for the 2022 taxable year would be April 15, 2023. Okay, there's no extensions. So it needs to be done by the April 15th. The two characteristics of the traditional IRA, it's tax deductible and deferral, right? Your money grows without tax. What does deferral mean? It means that when you buy Tesla stock or Apple stock or real estate or mutual fund 1 or ETF 2, and you sell it, or any income or dividends from that investment, it goes back to the IRA without tax. Okay, so take a simple example, right? You make $100 in a taxable account and assume a 20% tax rate, and you make $100 in an IRA. With a taxable account, you're left with 80. With an IRA, you're left with 100. So you do that over 10, 15, 20, 30 years, guess what? You're going to have a lot more money in a retirement account than you will if you did this investment in a taxable account. Okay, and that's the beauty of the retirement system. That is what is not being educated and being more widely dispersed to the population, is that the concept of tax deferral. Compounding interest. Don't trust me? Albert Einstein said compounding interest is the eighth wonder of the world. It's how smart people invest. Okay, and that's again, why I love the U.S. retirement system so much, and why I'm so passionate, and hopefully going to teach all of you smart attorneys what you potentially can do with your money, right? If you're watching or listening to this, you're an attorney, so you probably, do pretty well. So you're generally going to have income. If you're watching this, you may be retired, but you may also have some income. Maybe you're doing consulting or some other work. So you should have $6,000 or $7,000. Okay, and we'll talk about income limitations and what that means, but you should be able to make an IRA contribution. So let's talk about the distribution rules. The government, when they created IRAs and ERISA, they also want to force us to save. So they know Americans love to spend. So they gave us some incentives, right? They gave us the tax deduction, which is great, meaning if you put $6,000 in an IRA, you make $40,000 of W-2, you're going to pay tax on approximately $34,000. So they gave us that tax deduction. They gave us deferral. When you invest your IRA money, it grows without tax, which is amazing. But they don't really trust us. So they said, listen, you got to wait to pull this money out. We don't want you making $6,000 IRA contributions in 2021, and then in 2023, pulling that money out, raiding your retirement account, and then blowing it on a Rolex watch or a car or a Disney vacation. No, we don't want that to happen. We can't stop it from happening. We're going to make it really painful. So what they did is they added a 10% penalty if you pull the money out before 59 and a half. Okay, and they're saying you can do it, but it's going to be painful. That's the toll you're going to have to pay to get access to your money. If you're over 59 and a half, just tax, right? You have to pay income tax. Your money grew without tax. You got the benefit of a deduction up front, but when you pull it out, you got to pay tax. Now, when you hit 72, you have to take what's called a required minimum distribution. That age has gone up from 70 and a half to 72 starting in January 1, 2020, thanks to the Secure Act. So now once you hit 72 in a pre-tax traditional IRA, you have to take out a little bit each year. It's approximately 3%. Okay, so you just need to kind of understand that and plan for that. So if you have $100,000 in your IRA and you hit 72, you got to expect you're going to take out at least $3,000, be required to, as an RMD each year and pay income tax on that amount. You can take more out, you can't take less. Now, what are the income limitations? So if you have earned income, you can put money in. If you don't, your spouse has earned income, you can piggyback off your spouse. Now, what happens if you have access to an employer 401k? Let's say you work at a company and the company has a 401k, or even if you don't participate, as long as you have access to a 401k, the IRS will limit you on how much you can contribute to a pre-tax IRA. And generally, if you make more than $208,000 in 2021 and you have access to an employer 401k, you will not be able to make a pre-tax IRA. You can do an after-tax IRA, which we'll talk about, which doesn't really make a lot of sense because you don't get the tax deduction and you don't get the power of the Roth, which we will discuss. So it's kind of stuck in no man's land. Or potentially you can do a backdoor Roth IRA if you make more than 208 grand, which again, I will get to in a few minutes. So if you make more than the 208 and you do not work at a business with a 401k, you don't have to worry. You can make pre-tax IRA contributions. But if you have access to a 401k, even if you don't contribute to an employer plan, you may be limited on how much you can contribute to a traditional IRA. If you make more than the 208, you may not be able to do a pre-tax IRA, but you still have two options. One's the after-tax IRA, which no one uses, and the second's the backdoor Roth, which is super popular, something a lot of attorneys do who make more than the 208, and it's a super powerful solution. So there you have it. That's a traditional IRA in a nutshell. You get the deduction, your money grows without tax. If you pull money out before 59.5, 10% penalty plus tax. Pull the money out after 59.5, just tax. Hit 72, got to deal with RMDs. Okay, that's really it in a nutshell. If you make more than 208 and you have access to an employer 401k at work, you may not be able to make contributions. The Roth IRA, which I'm a big fan of the Roth. I wrote a book on it. It was really just created in 1997 by Senator Roth. And it's kind of the opposite of the pre-tax IRA. It's really an after-tax account. So what does that mean? You do not get a tax deduction for the contribution. Okay, unlike the traditional pre-tax IRA, you make 40 grand, you put $6,000 in a traditional IRA, you pay tax on 34,000. In a Roth, if you put $6,000 in a Roth IRA and you make 40, you still pay tax on the 40. So what's the catch? The catch is, so long as you're over 59.5 and the Roth has been open at least 5 years, so and 59.5 and 5 years, all the money you pull out is tax-free. Okay, I'm going to repeat that. Traditional IRA, right, 59.5, pull the money out, pay tax. Right, you got the tax deduction, so that's cool. But once you hit over 59.5, pay tax. Roth IRA, no tax deduction. But once you're over 59.5, tax-free, tax-free, tax-free. Never pay tax on any of those funds. So you can imagine the strategies people come up with to get more money in a Roth IRA. It's obviously the best legal tax shelter out there, right? What's better? Shelter your gains from tax. No tax. Nothing. No capital gains, no ordinary income, zip, zero tax. So you could understand now why the Roth IRA has become such a popular strategy for investors. Now, there is income limitations like the traditional IRA where you have access to a 401k at work. If you make more than 208, if you're married, file jointly, or 140 if you're single, you can't do a Roth IRA. The IRS, for some reason, doesn't want you to do it. Now, before 2010, you actually were stuck. You just were really out of luck. There was nothing you could do. If you made more than the threshold limit for that year, you couldn't have a Roth. Just couldn't do it. Now, what happened? 2008, we all remember the financial crisis happened. Okay, and it was obviously devastating, especially in New York. And what happened is the IRS, Treasury, they needed money. Right? People weren't paying as much in taxes because their incomes and their savings and investments dropped. So the IRS changed the rule and said, listen, we need tax revenue. So even if you make too much money, we're still going to let you do conversions. And in fact, we really want you to convert your pre-tax to Roth. Before 2009, you couldn't do Roth conversions if you made more than the income limitation. You just were stuck. But conversions are good for the IRS and Treasury because it's money, right? Instead of having to wait till you're 72 to pull out money, they get the tax up front. You know, for example, I have 100 grand in my traditional IRA and I want to go Roth. Why do I want to go Roth? Pretty obvious, right? I have Bitcoin, I got Tesla stock, Apple stock, great appreciating asset that I only think is going to get more valuable over time. So if I do the conversion today, lock it in, bang, I pay tax on today's value. And so long as I'm over 59 and a half, the Roth's been open 5 years, everything's tax free. So that's the strategy. So before 2009, you couldn't do it. Government said, okay, we need money. Let's entice people to do conversions. So we're actually going to let them pay it over 2 years. Now that ended in 2010, but it opened the door for no income limitations for conversions, which the government hasn't fixed. Why? Because they realize that conversions are good because you get the tax money today versus waiting till someone's 72. So they just never went back and put that rule into effect again. So now you can do Roth conversions even if you make $1 million a year. That means if you have a pre-tax IRA, let's say it is Apple stock that's dropped 20%, or it's Bitcoin that's dropped 30%, or it's a piece of property that's dropped 40%, you can do the conversion, pay the tax today, have it move into a Roth IRA, wait till you're 59 and a half, Roth's been open at least 5 years, no tax. A few other things. No RMDs for a Roth. That means when you hit 72, you don't have to take required minimum distributions. You can pass that to a spouse upon your death. Now, the one caveat is the Secure Act back in 2019 changed something for the non-spousal inherited IRAs. So the way it works is if you leave your IRA, traditional Roth, SEP, simple, to a spouse, the spouse is able to put the IRA into his or her name, right? So it just kind of becomes theirs. So if your spouse is 62 and you pass away and you're 74, the IRA goes to your spouse, and then your spouse just has the IRA at age 62, and then they can wait 10 years to do the RMD. Now, if God forbid both spouses die, or you're not married and your beneficiary is a non-spouse, the Secure Act now makes them take the money out over 10 years. You used to be able to stretch it over the life expectancy of the non-spousal inherited individual or trust. Well, trust was 5 years. Now everything's 10 years. So simplify things, less strategy now, because you used to be able to play around with life expectancy and leaving more money in IRAs to younger people. But now, if you leave it to a non-spouse, it's 10 years, they have to pull the money out. If it's a pre-tax IRA, they have to pay tax when they pull the money out. If it's a Roth, you just have to pull it out, no tax. Okay, so it's 10 years though. Now, if you leave it to a spouse, IRAs are part of your estate, right? If it goes to a spouse, then obviously there's no estate tax. It's only when it goes to non-spouses that the estate tax will kick in. Now, you also have to take into account your unified credit, which is obviously in 2021 quite high, approximately 11.7 million. It could drop. And then depending on where your IRA value, that could put you over that limit or not. But IRAs are part of your estate. You move it to a spouse, the spouse takes it in his or her name. If you move it to a non-spouse, they have 10 years to pull that money out. Roth IRAs, the key is to hold it to your 59 and a half, and the Roth's been open 5 years. If you pull it out before you reach those two thresholds, where it's a qualified distribution, you're going to pay tax and a 10% penalty on anything above the contributions. Contributions you can always pull out. If you put $3,000 in a Roth IRA today, you can pull it out tomorrow. Tax-free, penalty-free, right? After tax money. The earnings, you need to wait to the 59 and a half and the 5. Okay, so that's key. So Roth IRAs become more powerful over time. Why? Based off the power of compounding interest, compounding returns, your money grows quicker when it's not subject to tax. And the Roth is the best strategy for magnifying that solution. Okay, but again, it's based over time. The more time you have, the earlier you start, the more consistent you are. You need to wait your 59 and a half. The Roth's been over 5. You can really take advantage of the power of the Roth IRA. Now let's just jump back real quick. Let's say you make more than the 208 or the 140 single. You want to do a Roth. What do? So this is a trick that the IRS has known about for many, many, many years, at least 10, 11 actually now. They haven't decided to stop it. and it's called a backdoor Roth. And what it means is you basically make a contribution to an after-tax IRA. So it's a traditional IRA, you just do not take the tax deduction, right? We know that if you make more than the 208 and you have access to a 401k at work, you may not be able to make a pre-tax contribution. So what happens if you want to do a Roth? Well, you make more than the 208. So the pre-tax IRA is off the table. Now, what happens is you just make an after-tax traditional IRA. It's basically the same traditional IRA. You just don't claim the tax deduction on your return. And then you open a Roth IRA and you have your custodian or your bank, your financial institution, convert it to Roth. Now, since you're converting after-tax funds, right, nothing's earned. You're doing it assumingly a few days after you made the contribution. You just move it to Roth. And now you're able to take after-tax money and move it to Roth. Why don't you want to stay in the after-tax world? Well, in the after-tax world, all the earnings are subject to tax. Whereas in a Roth, so long as you're 59 and a half and the Roth's been open at least 5 years, no tax. So the after-tax IRA is not a really good solution because you do not get the tax deduction like a pre-tax IRA, and you don't get tax-free growth like a Roth. So again, it's like in no man's land. Why would you want to be there? You don't want to be there. You should never do an after-tax IRA unless you want to do a backdoor Roth IRA. That is the only reason to do an after-tax IRA. So that's the trick. Now, one thing to keep in mind, again, there's no income limitations for Roth conversion, but if you have other taxable IRAs out there, let's say 4 years ago you rolled over a 401k from a previous employer, or you made an IRA contribution 15 years ago, it's kind of sitting there. You have to take that into account when you're doing this backdoor Roth. So what does it mean? Here's an example. Let's say you had $5,000 IRA from a couple years ago, sitting at Schwab or Fidelity, or you're just kind of invested stocks or mutual funds. And now you want to do a backdoor Roth of $5,000 today because you make more than the 208 and you really want to get more money into the Roth. So the way the rules work is if you do that $5,000 after tax, when you do that backdoor Roth, you have to do a formula which basically says you take all your pre-tax IRAs and you add it to what you're doing now. So that's 5 plus 5 in this example is 10. And then you're only able to get a pro rata percentage, the 5 over the 10, the 50%, into the Roth. So in this example, if I have $5,000 pre-tax IRA hovering out there, now I want to do a backdoor Roth IRA of $5,000. I got 10 total. I want to backdoor 5. Only 50% of the $5,000 would be considered Roth. The $2,500 will still stay after tax. And I got to keep doing this for a few more years to kind of get everything into Roth. So there's that pro rata formula you got to keep in mind. Now, if you don't have any other pre-tax IRAs out there, nothing to worry about. Whatever you move to after tax, you can convert to Roth and be secure in the fact that you'll have those funds in Roth. It's only if you have other pre-tax IRAs out there, because there's no limit on how many IRAs you can have. People ask this question all the time. You can have 1 million IRAs. You just can't go above the $6,000 or $7,000 contribution limit. So one other thing to keep in mind, people do get confused between contributions and investments. Just to be clear, contributions, again, come from earned income. And that's limited to $6,000 or $7,000 for 2020 and 2021. Income, growth, investment returns are uncapped. So you can turn $6,000 into $6 million. That is not capped by the contribution limit of $6,000 or $7,000. The cap only applies to how much you can contribute to an IRA, either to get a tax deduction or to put into a Roth. Your gains and returns on your IRA are unlimited. Okay, and that's important to keep in mind. So that's the backdoor Roth. So let's just do a quick recap. Traditional IRAs, I know it's confusing. There's a lot of terminology, but it's super important that you guys just understand this because it can really make a huge difference in how you save and how you generate wealth for your retirement. Traditional IRA, tax deduction, over 59.5, just tax on what you pull out. Over 72, RMDs, about 3% a year. If you pull money out prematurely under 59 and a half, tax 10% penalty. If you make too much money, 208, married, filed jointly, have access to a 401k, you may not be able to do a traditional IRA. You're going to have to probably do a backdoor Roth. Roth IRA created in 97. It's the opposite of the traditional IRA. No tax deduction, but the huge bonus is once you're over 59 and a half, Roth's been open at least 5 years, no tax on what you pull out. Nothing, zip. Okay, so that's the key. If you pull money out prematurely, tax 10% penalty on all the earnings on your contributions. Contributions can always be taken out tax-free. No requirement of distributions, which is nice. If you pass away, IRAs go to a spouse, tax-free. The spouse generally will put the IRA in his or her name, and then the same rules will apply to that spouse based off his or her age. Pass your IRA to a non-spouse, 10-year time period to pull the money out. IRAs, Roth IRAs are individuals. Businesses don't set them up. If a business wants to set up an IRA, there's two options. It's called the SEP IRA and the Simple IRA, which we'll talk about. SEP IRA before 2001 was the most popular business IRA. It has been passed by the solo 401k, which I'll briefly discuss for a number of reasons. The SEP IRA, just think about it simply as a profit sharing plan. Okay, it's really a traditional IRA concept in a profit sharing plan. So a traditional IRA, you can put away dollar for dollar, 6,000 or 7,000 if you're over 50 in 2020, 2021. Profit sharing plans are a percentage. So a SEP IRA is either 20% of your net earnings or 25% if you are a W-2. So again, SEP IRAs are created by businesses. If you are just an individual that, let's say, works at Apple or works at XYZ law firm or Smith & Smith law firm, and all you do is earn income, W-2, you're not a partner in the firm. If you have access to a 401k, you can make 401k contributions, of course. If you don't have access, or even if you have access and you make less than that 208, if you're married, filed jointly, you could potentially do traditional IRA contributions, $6,000 or $7,000 if you're over 50. Okay, you're not in business, so you're going to set up a traditional IRA or a Roth IRA. Now, the law firm could set up a SEP IRA, and many law firms do. And the SEP IRA would provide profit-sharing contributions up to 20 or 25%, depending if the business is a sole proprietor, one-person law firm, that would be 20% if they're Schedule C or single-member LLC, 25% if they're W-2 or guaranteed payment partnership. So, for example, keep things simple. One-person lawyer, sole proprietor, makes $100,000 net after deductions. Their net Schedule C net earnings, $100K. They can put away $20,000 into a SEP IRA. Okay, that is obviously more than the $6,000 or $7,000 they could in a traditional IRA. If they were a W-2, meaning they work at a law firm or they're partners in a law firm, 25% of their W-2. It's not the profits. It's based off W-2 if you are a partnership or a corporation, or your net Schedule C, single member LLC, or sole proprietor. And the maximum you can put away in 2021 is $58,000. SEP IRAs you can set up until your company files its tax return, including extensions. So for 2021, you can file a SEP and make contributions up until your company or firm files a return in 2022, including extensions. So it's a great plan, right? You can put away more than that 6,000 or 7,000. It's tax deductible. The money grows without tax. Same rules as an IRA. There's requirement of distribution rules. Distributions are subject to tax. Under 59.5, tax and 10% penalties. It's pre-tax like a traditional IRA. It's really just a traditional IRA for a company, but instead of going dollar for dollar, $6,000 or $7,000, you can do percentages, 20% or 25% for W-2, up to a max of $58,000. Generally, you make contributions across the board for all participants, and you don't have to go as high as 20 or 25. That is just the maximum. Okay, you can do 1% or 5% or 10% or 15%. It should be the same for all participants. Now, there's some other quirky rules. There's this 3 out of 5 eligibility rule. It means that You only have to make these profit sharing contributions for employees if they work more than 3 of the last 5 years for you. So if you just started this law firm and it's just you and a partner and you have one employee who just started this year, you can do profit sharing contributions of 20 or 25%. You just don't even have to offer that employee benefits because they haven't worked the 3 out of the 5 years. So it's a kind of a quirky rule. And again, these are contributions that are on the tax return. If it's a partnership or LLC, it flows through to you as a tax deduction. If it's a corporation, it's a corporate tax deduction to the company or business or firm, but the individual gets the benefit. And obviously the double benefit is your money grows without tax, you can invest it, and you get the tax deduction. Simple IRAs are not as popular as SEPs. Simple IRAs, it's kind of like a poor man's 401k, right? A 401k in 2021, you can put away as an employee deferral $19,500 or $26,000. Okay, simple IRAs $13,500 and have a $3,000 contribution catch up, so about $16,500 versus $26,000. So number one, you can't put away as much, which is one of the reasons that many firms, businesses don't set them up. Why do most businesses and firms set up retirement plans? Generally to help the owners / partners out. Also, of course, they want to take care of their team, their employees, their attorneys, but generally who drives the car, who drives the decision? Generally the owners of the business. So the owners will generally want to put away as much as they can, and that's why they will gravitate towards the 401k over the simple. But the simple has some nice features. It has the same pre-tax contribution features, the same distribution rules as the IRA, but there's no triggering events. So what that means is in a 401k, you can't really touch your money until you're 59 and a half or you leave your job. With a simple, after 2 years, you can technically roll it out to an IRA. You have more investment options. Instead of paying for a third-party administrator to administer your 401k, in a simple IRA, the bank, financial institution like IRA Financial would do all the admin. So it's actually cheaper than having a TPA. There's no loan feature, smaller contribution limits, but it does have some features in terms of cost and a little bit more flexibility than a 401k, but it's still not as popular. You only can set it up from January to October 1st, whereas the SEP IRA, you can set up until you file your return for that year, including extensions. And you don't have to make contributions for employees that don't make at least 5K. So I talked about the SEP IRA, the simple IRA. These are business IRAs. So you need to have a business to set up the SEP or simple. If you're retired or on Social Security or disability, play golf all day, or you knit, or you just hang out, you're not going to set up a SEP or simple. If you have a prior employer 401k and you want to roll it in and you're not employed or you don't have your own business, you're not going to roll it into a SEP or simple. You're going to roll it into a traditional IRA. Okay, so SEPs are super popular with law firms, but they're not as popular as what's called a solo 401k. Solo 401k was basically reborn after the 2001 EGTRA, the Economic Growth, Tax Relief and Reconciliation Act. President Bush signed into law after 9/11. Before EGTRA, the solo K was basically the same as the SEP. It was a profit sharing plan, 20 or 25%. That was it. So no one really did solos or KEO plans because it was easier and cheaper to administer a IRA. So that's what people did. They just gravitated towards SEPs. But once EGTRA was passed, it added a lot of really cool features to the solo K that now make it the most popular plan for the self-employed. Why? SEP, profit sharing plan, right? 20 or 25%. 401k has profit sharing plus the employee deferral of the 19.5 or the 26 if you're over 50. So if you made $100,000, you're under 50 years old, sole proprietor law firm, SEP's going to give you 20K, 20% of 100 max. The solo K will give you 19.5 plus the 20K, 39.5 in 2021. Why do you care? Well, again, more tax deductions, more money you can put away without tax. If you're looking for tax deductions, the solo is going to beat the SEP every time. It's the way it is. It also has a Roth feature. SEP doesn't have a Roth feature. Also has a catch-up contribution. If you're over 50, you can add another 6,500 in, right? You can go from the 19.5 to the 26. SEP IRA, you're stuck at the 58. Over 50 in the solo K, 58 to 64.5. Okay, again, this is solo. So it's only for businesses that have no full-time employees other than the partners or owners. Full-time means over 1,000 hours. So you have a two-person law firm, just the partners, kind of do all the work yourself. You have an assistant, works under 1,000 hours. You can set up a solo. Or you have a sole proprietor business, sole proprietor law firm. You're going to want to go solo over SEP. What happens if you have employees over 1,000 hours? You're not going to be able to do the solo. You're going to do the regular 401k, which will give you that 19.5 or the 26. But if you do the profit sharing, you may have to give some to your employees. You also may have to do what's called safe harbor contributions if you end up doing a safe harbor plan. A little bit more complex than the solo, a little bit more admin costs, but it will give you more than the simple. And will also cost you probably less than the SEP in terms of out-of-pocket contributions needed to be made to employees. So if you have a law firm and you have full-time employees over 1,000 hours, you're probably going to have to look at the 401k. If you're self-employed or have a law firm where it's just the partners, go solo. You're going to be able to put away more than the SEP. You guys can make your own investment decisions. You have total control. And you can do pre-tax, you can do Roth, you can put away more than the SEP, you can do catch-ups. There's also a loan feature, meaning you can borrow $50,000 or 50% of your account value, whatever's less, and use that for any purpose. So instead of using money and needing to get a loan, use a credit card. If you have expenses, either personal or business, you can do a loan through a solo K and borrow $50,000 or 50% of your account value, whatever's less. Use that for any purpose, right? SEP IRA, no loan. Can't borrow a dollar from an IRA. The only time you can take money out of an IRA, we said distributions under 59.5, tax and 10% penalty. Over 59.5, tax. There's something called hardship distributions where you can pull money out of an IRA without 10% penalty if you're under 59.5, but still with tax. Hardship could be for education costs, severe economic needs, pay IRS levies. There's a first-time home buyer of up to 10K. So there are some potential hardship exceptions to the 10% early distribution penalty, but you're still going to pay the ordinary income tax on what you pull out. The loan gives you that tax-free cash. So if you have 100K in your 401k, you can borrow 50K. Now you get tax-free, penalty-free use of the money. Use it for anything. Pay it back over 5 years, at least quarterly. As of May 1st, 2021, interest rate of at least 3.25%. So pretty inexpensive use of money. And you're paying yourself back. You're not paying a credit card company or a bank. You're paying yourself. So you get tax-free, penalty-free use of that cash. And your plan is growing because it's getting the 3.25% on your loan amount. So I think it's pretty cool. It comes in handy. And I think it's another benefit of the solo versus the SEP. So again, this is only if you're listening or watching out there, you have your own law firm, self-employed, no full-time employees over 1,000 hours. You got 1099s or just partners doing all the work. Kind of sucks, but the advantage is you can do a solo 401k. So that's, the one advantage of doing all the work yourself is you can do solos instead of being stuck in a regular 401k, which is not going to let you put away as much, or it's going to cost you more to just max out because you're going to have to potentially offer some benefits to your employees. Or you can go SEP, or you can go simple, or you can just do a $6,000 or $7,000 IRA or Roth, but that's going to be limited to just that small amount. Okay, so it also gives you some really nice credit or protection. The one nice thing about IRAs is generally under the 2005 Bankruptcy Act, IRAs are protected from bankruptcy up to 1.1 million or so threshold. This is a federal bankruptcy rule. If you want to look at protection from creditors outside of bankruptcy, so you're worried that someone's coming after you personally, you don't want to declare bankruptcy. Generally, most states will protect your IRAs, including New York. But you'll have to look at your state-specific statute to determine the exact protection that your IRA will have against creditors outside of bankruptcy. If you're in bankruptcy, generally the Bankruptcy Act will cover you depending on your state. If you are worried about creditor protection outside of bankruptcy, then you'll look to the state statute, and generally New York will protect you and protect your IRA from creditors or tax personally. So it's another really important advantage of having money in a retirement account is you will get better creditor protection than if you had that money just sitting out in a savings account, which may not provide you any creditor protection.
If you're in a jurisdiction that requires a verification code, please write the following code word down. COLD. C-O-L-D. COLD.
So let's talk about investment options. I spent the last 45 minutes or so just talking about the basic rules of IRAs, which are, a bit dry, right? Talked about contributions, distributions, RMDs, talked about some of the rules in terms of SEPs, simples, eligibility, the difference of what you're going to set up if you're a business, whether it's a SEP, simple, 401k, solo 401k, or even a regular just IRA or 401k. Now I think we're going to get into some of the cool stuff. Investments. What can you actually do with your IRA? And this is something that most people, even lawyers, smart lawyers like all of you, and even tax lawyers don't know about. I'll give you this example, and I've said it in the beginning. I'm a lawyer, clearly. I have a master's in tax law. I worked at really large firms in New York for 9 years before I started IRA Financial. If you asked me, can your IRA buy real estate? Can your IRA invest in a hedge fund? Can your IRA do investment notes? Can your IRA invest in Bitcoin? I would have said no chance, right? IRAs need to be invested in stocks, mutual funds, right? That's what I invest my IRA in. What's the deal? So it took a client of mine. It was one of the last things I did as a practicing attorney back 08 or so. I was asked to research whether a client could use their IRA to invest in a hedge fund. And they were involved in this hedge fund. And this is a big firm. And at first I was like, well, I don't think you could, right? It seems alternative. Thought IRAs can only do stocks or mutual funds or ETFs. And I started digging around, right? Looked at the tax code, found section 408, 4975, which we'll talk about. Asked around, went online, checked out tax treatises, and then kind of a light bulb went on, I should say. And it's like, oh my God, you can do this. This is so cool. And there's hardly any information out there. Wonder why. Why is it that hardly anyone knows that you can do alternative assets with your IRA? Started doing more research. I said, well, this is really interesting. This industry, self-directed IRA industry, pretty much encompasses everything I really have faith in and believe in and support. And that is tax, the ability of the tax code, deferral, which since I was young, my parents always taught me, save money. Your money grows faster without tax. So this whole industry really added several passions of mine. The tax code, deferral, and then the last one is control. I've always felt that you should have control over your money, right? You should have the ability to invest in what you want so long as it's legal based off the code. And I couldn't understand why so many people didn't know that you can do alternative assets. So I wanted to talk about investment options because I'm not telling anyone what to do with their money. I'm just a dumb lawyer, right? I'm not an investment advisor. I don't give investment advice, but I think it's important that people understand what the options are. So let's start with the tax code, right? Internal Revenue Code has two sections that are relevant as to what you can do with your IRA. And it's called section 408 and 4975. 408M, as in Michael, basically says you cannot invest your IRA in life insurance and you can't invest your IRA in collectibles. And they list a whole few, but it's basically the idea of diamonds, baseball cards, stamps, antiques. And obviously, the code, when it was written some time ago, at least this section, didn't take into account digital assets like non-fungible tokens or NFTs, which the IRS hasn't even commented on. Is that a collectible? So this stuff is still relevant, but generally collectibles are collectibles. You know what a collectible is when you hear it or you touch it: comic books, baseball cards, stamps, antiques, rugs, diamonds, gems. So you can't invest your IRA in that. Understandably, including art, is the IRS feels that there's not an ascertainable value to those assets. And why does the IRS care about value? Why are they so focused on value? Well, remember I talked about distributions, talked about required minimum distributions. IRS is very, very, very interested in value. That's actually the one item that they care most about when it comes to IRAs. That's in fact why they ask the banks, financial institutions, or trust companies that custody IRAs to provide them with the value of the IRA each year on a Form 5498. They care because they want to make sure they have a good gauge of what your value is of your IRA when you reach 72 and you have to start taking the required minimum distributions, right? That's a huge, huge, huge source of revenues, right? $11 trillion in IRAs. Let's say 60, 70% of that are in traditional IRAs. You can see the amount of tax revenue at stake. Again, they gave us a tax deduction for making traditional IRAs. They expect to collect the tax at some point, and they want to make sure that they enforce their collection responsibilities. There's a lot of tax revenue at stake. So they're worried that people can play around with values, right? You bought a piece of art for 100K in 2001. Now you're turning 72, is 2022. Can you say that art's worth 30 grand? Or is it only worth 110? Or is it really worth 10 million and you're saying it's worth 300,000? So they were a little bit concerned, so you can't do it. That's what 408M says. 4975, which I'm going to talk to in some detail shortly, basically is the broadest category of what's called prohibited transactions. And it's a federal law applicable to all IRAs, which are federal individual retirement accounts based off Section 408, Roth IRAs 408A of the Internal Revenue Code. Okay, so they apply no matter where you are, New York or some other state. Now, 4975 says clearly, basically in sum, that you cannot do anything in your IRA that in any way, directly or indirectly, personally benefits you, disqualified person, which is essentially lineal descendants of yours, or entities you control. Okay, and we're going to get at some really cool examples. But they're basically saying, listen, if you want to take your IRA and use it to buy a house, buy yourself a car, buy yourself a watch, buy an apartment for your kids, then pay the tax, right? Give us our tax money and then do what you want with it. But we need to protect our ability to collect tax. Too much money at stake. So they created these rules to basically not allow you to self-deal, right? Because they figured, hey, if you're giving money to your spouse, if you're giving money to yourself, if you're giving money to your kids, it's basically like doing it yourself, giving yourself that benefit. And that's not fair. Then no one would ever pay tax, right? Everyone would just do prohibited transactions, give money to their kids, their spouse, and there would be no money left for the IRS to collect, at least until they're 72 and have to take RMDs, but people wouldn't be taking distributions earlier, which they were concerned about. So again, 408, you can't do collectibles, can't do life insurance. 4975, you can't essentially do self-dealing. You can do everything else. The IRS doesn't list what you can do. So if you open the tax code right now and look at 408 or 4975, you're not going to see a list of investments like stocks or mutual funds or real estate or ETFs. And that makes total sense, right? Because look at the digital asset industry the last 10 years. They would have had to amend the tax code to include all these different assets like cryptocurrencies or like potentially NFTs or other SPACs or other types of investment vehicles that have gained popularity. So they were smart and basically just said, okay, this is what you can't do. And essentially 97% of all IRAs are invested in traditional investments. Now, for good reason, right? If you look historically, the stock market is average return is close to 10%, right, over the last 100 years, S&P 500. So there's good reason most people invest their money into stocks or mutual funds or ETFs, and that's fine. But there's also a growing interest in alternative assets. People want to diversify. People want more control. Some people don't trust Wall Street, right? So there's different ways and different reasons why people want to make different investments with their IRA. Okay, so if you break down the three different types of self-directed IRAs. Now, when I use the word self-directed IRA, you may see that word a lot. You're not going to see it in the tax code. Okay, it's basically a made-up word. It basically, you can make an argument that every IRA is self-directed, right? If you go to TD or Bank of America or Schwab, they'll let you choose what your IRA invests in, right? You're the fiduciary of your IRA. It's very rare that you're just going to go to TD Ameritrade, go to E-Trade, and say, you know what? Take my IRA, invest it, right? That's not going to happen. You're going to have some control. So every IRA is in a sense self-directed. It's just the level of control you have. So the traditional banks, financial institutions, they'll let you buy anything they sell, whether it's stocks or mutual funds or ETFs. So they claim you have a self-directed IRA. In essence, you do, but they're not giving you the full gamut of investment options. They're saying, hey, you can buy any stock you want, or the mutual funds we sell, or the ETFs we sell or carry or support, but that's it. So it's self-directed in the sense that you're doing it, not them. You're saying if it's Tesla or Apple you want to buy, but it's really not self-directed because you're not able to do real estate or other alternative assets that are allowed under the tax code. Now, to be clear, every bank, financial institution, custodian of an IRA can choose what they allow their clients to invest in. There's no reason Fidelity has to allow you to buy real estate or a private equity fund or a hedge fund with the IRA they custody. It's their right to say no. Okay, and why would they say no if you wanted to buy real estate with your IRA? Well, it's pretty obvious, right? They don't make money when you buy real estate. If you have $100,000 with Fidelity and you want to pull it and buy a home in Long Island or in Rochester, they just lost that 100K. That 100K left their bank, financial institution, their account, and went somewhere else. So not really in their incentive, not really in their best interest to allow you to do that. And that's why they don't. But ERISA created IRAs. 4975 was developed after ERISA. And a huge growing industry called the self-directed IRA industry was born in 1974 that serves millions and millions and millions of Americans who want to do different stuff with their IRA. Now, it's roughly 3 to 4%. It's growing fast of the total retirement market. And yes, I obviously believe in the self-directed world. I believe in diversification. I believe in giving people and educating people about what they are able to invest in. But I'm not sitting here saying you have to do real estate or you should do private equity or Bitcoin. I don't really care, right? I'm here educating people to say, hey, know what your rights are. Know what the tax code says. Everyone should know. Everyone. Most people don't, including myself. I had no idea before I got into this industry that you can do real estate with your IRA. So if I didn't know, I'm sure there's millions and millions of people out there that also don't know. And again, that doesn't seem fair. So there's two ways to kind of get into alternative assets with your IRA. If you want, you can have the custodian make the investment for you, which is kind of like a self-directed custodian controlled approach. You basically will roll over your IRA from Fidelity or Schwab to a self-directed IRA custodian like IRA Financial. And then you'll direct them where to send the money. The account will be opened in the name of the IRA, and then all the income and gains will flow back to your IRA without tax, right? And clearly why you want to go self-directed. If you do, you want diversification. You want to invest in what you know and understand. Some fear of Wall Street, hard assets like real estate, seemingly a good hedge against inflation. And people like cash flow, right? Rental real estate, for example. Okay, and there's a lot of different tax strategies for doing alternative assets or even just traditional investments with your IRA. The clear is the deduction versus a Roth tax-free growth, backdoor Roth IRA great way to dump more money into your Roth IRA. Deferral, keep talking about deferral, but it is the best way to save for retirement. Compounding returns, your money grows faster without tax based off compounding returns system. If you generate an 8% rate of return, your money will double every 8 years. Okay. And if you're doing conversions, there's some stuff you can do with discounted asset valuations, just like you can with family limited partnerships or estate planning. There's some strategy in that. But overall, there's some really cool stuff you can do with your retirement account, not just growing it through contributions or rollovers, but also taking advantage of the tax code by either getting deductions, taking advantage of the Roth and converting to Roth at low value. And especially in an environment where we may see higher taxes in the next several years, you're going to see more and more people want to get assets into a Roth IRA to shelter the income from tax. Right? And here's some more information on deferral, which talked a lot about it. It's obviously the primary engine of the U.S. retirement system. Here's some examples. I just wanted to kind of throw this out there just to kind of put the numbers in front of you so you can see what I really mean. Basic example, age 22, put $3 a day away, $1,095 a year. You retire to 70, even though the 72 is the RMD age. And assuming you just do $1,095 from 22 to 70, you never increase it, right? Even when you're 26 or 46, when you make more money. No, you just stay at $3 a day. From 22 to 70, you get an 8% rate of return, which is good, but it's not like super aggressive. You'll have $579,630 at age 70, tax rate, right? You're over 59 and a half. Roth's been open 5 years, bank, tax rate. Not bad. Yeah, there's time value of money. In 50 years, 579 may not be worth what 579 is today, but it's money. It only costs you $3 a day. And if you did it in a taxable account at a 25% tax rate, you'd have less than $300. So that's the key, right? If you just did this savings of $3 a day in a Roth IRA, again, I don't care what you invest in, whether it's stocks or real estate, it doesn't bother me. As long as you saved, you were consistent, did this each year, trusted the process, you waited. At 70, you got 579. Now let's supercharge it a little bit. Let's say you start at 28, right? 22, you start working, you want to have some fun, you got to pay off your education loans, maybe you're getting married or whatever it is, you got some other expenses. Now it's 28, you got a little bit more money. You say, you know what, I'm going to put away $5,500 a year. Not the $6,000, but I'm going to put away a good chunk. Do this to 70, even assuming contribution limits go up, which they are already, $6,000 today, and they're going to keep going up. Just do the same amount, $5,500 from 28 to 70. Assume an 8% rate of return, which is good, but not amazing. $2.295 million. Okay? No joke. If you did it in a taxable account, $1.1 million. So you can see your money grows faster without tax, right? 2.2 versus 1.1. 5,500 is a lot of money. I'm not saying every 28-year-old can do it. I got you. But if you're able to, let's say you started a law firm job at 28. You graduated college 22, 25. Let's say you take a year off. You go to law school, it's 26, 27. You start your first job. You're not making $1 million a year as a lawyer first year. Let's say you're making 75 grand or 100 grand or 150, depending where you work. Maybe you can put away $5,500. Maybe you can't. But let's say you push yourself to save $5,500 over the year, not a month, over the year, 28 to 70. Okay, you got to wait. I'm not saying it's instant gratification. I'm not saying you're going to have $2.295 million at age 30. But save. If you're going to save, do it in a Roth IRA. Do it in a 401k. Do it in a Roth 401k. It works. Deferral, compounded interest. It works whether you're in New York, Texas, Idaho, it doesn't matter. It's all based off the U.S. federal tax code, and it's based off the power of deferral. So again, I talked about what you can invest in, 408, 4975. Let's talk about some of the important 4975 rules. So who's a disqualified person? Because that's key. That's probably the most important determination when you look at whether a transaction is prohibited or not. So if your IRA buys Apple stock, pretty safe, right? You don't own, even if you work at Apple, you don't control Apple, right? No one does. Hundreds of millions of shareholders. Clearly, you're not personally benefiting. all the benefits being derived by your IRA when Apple goes up. That's good. Who's a disqualified person? So it's a fiduciary. It's you. Fiduciary means you have control over your IRA. You can't give up your fiduciary responsibility as a retirement account holder. Okay, even if you say, well, my broker does everything. I'm not a fiduciary. No, that's not true. You still are. Case law is clear because you can decide when you're going to take a contribution when you're going to make a distribution. So you're a fiduciary. Disqualified persons are also lineal descendants, parents, children, spouse, daughter-in-law, son-in-law. Siblings are not disqualified people. Either aunts, uncles, cousins, friends, girlfriends, boyfriends. If you provide services to a plan, like a TPA or a trustee or a custodian or a financial advisor, potentially could be disqualified. Okay, and obviously an employer if you're doing an employer plan. Okay, so essentially, in most cases, when you look at whether a transaction is prohibited or not, whether you can do it, you have to look at if there's a disqualified person on the other side of the deal. If it's you personally, it's probably dangerous. If it's a lineal descendant, probably dangerous. If it's an entity you own more than 50% of, probably dangerous. Okay, if it's a trust you're a trustee of or beneficiary of more than 50%, probably dangerous. Okay, if it's a entity that you own more than 50% of, or you're a 10% owner, or your IRA becomes a 10% owner of an entity you own more than 50% of, could be an issue. Okay, so anytime you or a lineal descendant or company you control is on the other side of the transaction, you need to be cautious. Okay, who are not disqualified persons, brothers, sisters, aunts, uncles, cousins, stepbrothers, friends. Why does the IRS care about this? Again, it goes back to distributions, goes back to tax revenue. The IRS doesn't want you just doing deals with your kids or your wife and just basically getting yourself the money you need without taking the distribution and waiting to 72 till you have to take that required minimum where you may have had to pay tax earlier. So they want to collect tax revenue. Believe it or not, the IRS actually likes pre-tax IRAs. You would think that doesn't make sense, right? You guys are lawyers, smart. You would say, wait, why would the IRS like pre-tax IRAs? Shouldn't they like Roths? Well, actually, they like Roths. Wait, what? So pre-tax IRAs, tax deduction, right? IRS doesn't like tax deduction. Why don't they like tax deductions? Because it reduces the amount of tax revenue they collect. Roth IRAs, wait, shouldn't they hate Roth IRAs? Because once you're over 50 and a half, they'll never collect any tax again. So if the government was logical, they would like traditional IRAs because your money grows faster without tax. So ultimately, when you're 59 and a half or at least 72, you're going to have a lot more money than what you started with. So there's more tax revenue to collect. Whereas Roth IRAs, they're not collecting anything once the Roth's been open 5 years and you're over 59 and a half. So why the heck wouldn't the government push us to do more Roths, right? Or are they? What's going on here? So the answer is this. Government doesn't care what happens in 30 years. The government cares about today. Tax deductions are not good for them. The more money they have to spend, the better they are now. So they like Roth IRAs, even though it's going to hurt the country in 30 years because there'll be less tax revenue. They want to push people into Roth IRAs. They don't like pre-tax IRAs. They also want tax revenue. So the prohibited transaction rules are super important because they want to make sure that they collect tax revenue. So they like Roths and they want to make sure people are not messing around with prohibited transactions. If you do a prohibited transaction, not going to jail, don't worry, but you're going to blow up your IRA and you're going to pay tax, 10% penalty if you're under 50 and a half, plus excise taxes of anywhere from 15 up to 100%. So they are going to penalize you. And they don't joke around about this stuff. Now, the IRS doesn't technically have an audit division for IRAs. It's part of the small business self-employment division. So if they audit your tax return, that's how they will audit your IRA. But they don't mess around. And they're very serious about this stuff. And I've been through some audits where I've seen clients who inadvertently, send $500 to an entity they control instead of a different entity they didn't, totally inadvertently, and they blew up their IRA. So you want to be super careful. You don't want to do anything prohibited. You don't have to. It doesn't have to be difficult. You just want to be careful. So let me just break down 4975. Okay, this is right out of the code. 4975 C1A. It says the direct, indirect sale, exchange, or leasing of property between an IRA and a disqualified person is not allowed. So example, Jack sells an interest in a piece of property owned by his IRA to his son. Disqualified, right? You have your IRA and you got your kid on the other deal, on the other side of the deal, no good. C1B, the direct or indirect lending of money or extension of credit between an IRA and disqualified person. Keith lends his wife 10 grand from his IRA. His wife's disqualified, got Keith's IRA there, no good. One other thing I should mention on credit. If you want to do a real estate deal with your IRA, the loan has to be a non-recourse loan. A non-recourse loan is a loan you do not personally guarantee. Why? Because of this. You cannot extend credit to your IRA, or your IRA cannot extend you credit. So you can't personally guarantee an obligation of your IRA. If your IRA wants to get a loan, it has to be a non-recourse loan you do not personally guarantee. So one thing to keep in mind. But in this situation, it's pretty simple, right? Keith lends his wife 10 grand from his IRA, no good. If Keith lent his neighbor, if Keith lent his brother, if Keith lent John Doe, that would be fine. That would be a perfectly good IRA transaction. All the interest from his loan transaction would go back to his IRA without tax. C1C, the direct or indirect furnishings of goods or services between the IRA and a disqualified person. Example, Eric buys a piece of property with his IRA and hires his father to work on the property. No good, right? His dad's providing services to an IRA, no good. If Eric hired his neighbor or his brother or his sister or John Doe, that would be fine. C1D. Okay, now D, E, and F are basically the catch-alls. And we'll get into some examples here. This is what the IRS uses to kind of catch people when they feel like they can't fit into A, B, or C. The direct or indirect transfer to a disqualified person of income or assets to the IRA. So here, Dan is a financial jam, takes $12,000 from his IRA to pay his mortgage or credit. Okay, in this case, it's direct, right? But what about indirect? What about if Dan lent money to a company that he owns 42% of because the company needed money? Is that a prohibited transaction, right? So in a direct sense, yes. And once you own more than 50%, we know the entity is disqualified. So Dan cannot lend $12,000 to an entity he owns more than 50% of. Here, in this case, his IRA just lent the money straight up. So that's a direct disqualified transaction, prohibited, easy. Anyone can figure that out. But what about this? It's actually a real case called Rollins v. Commissioner, tax court case. Interesting scenario. Mr. Rollins is an accountant. He owned less than 50% of a bunch of businesses. Okay. He owned them personally. He was not an employee, just an executive, director, not an employee. Owned less than 50%. So you'd say, okay, less than 50% should be good. Not a disqualified person on its face. Companies needed money, which is a really bad fact. Rollins took his 401k, lent the company money at prevailing interest rates. IRS took a look at this somehow. They said prohibited, self-dealing. They actually used D and E. And Rollins said, no, what are you talking about? It's a good transaction. I own less than 50%. It's not a direct disqualified person. The entity is not disqualified. I own less than 50%. And it's a good loan. My 401k did well. The company paid the money back. What's the problem? The IRS said, listen, actually the tax court said this. When you make an investment with your IRA, it has to be done to exclusively 100% benefit your IRA. There cannot be any direct or indirect benefit to you personally or any disqualified person. Well, in this case, Rollins did benefit, right? Because I mentioned the businesses were in poor financial shape and they needed money. So that was a bad fact. If the company was doing great, or if there were maybe 100 other investors out there, then maybe he would have won that case. But the facts were really bad. So again, even if you're under 50% and the entity is technically not disqualified on its face, you still need to be concerned with facts and circumstances. And you need to make sure when you make an IRA investment, it's done exclusively 100% to benefit the IRA. It cannot be done in any way to indirectly benefit a disqualified person. So let's look at C1E. The direct or indirect act by a disqualified person is a fiduciary where she deals with the income or assets of the IRA for her own interest, own account. So So here Jessica's a real estate agent, uses the IRA to buy a home and earns a commission. So yeah, Jessica maybe works at a big brokerage firm. Okay, anyone can provide that service. The IRA is buying the home. She's not going to live in the home. She's going to rent it out. But she's dealing with the income or assets, the IRA for her own interest, meaning she's having her IRA pay her for a service. So in that case, the IRS feels that that is not a proper transaction because in this case, could an argument be made that maybe Jessica's doing this IRA deal to give herself the commission? Or another scenario, right? You take a job and the job goes to you, okay, you can have the job, but Adam, you got to invest 50 grand to get your job. It's like, well, I don't have 50 grand. And they say, well, don't you have an IRA you can use? Like, yeah, I got an old IRA. Oh, okay, I'll invest the IRA. I'm going to own 1% of this business, but am I using the IRA to benefit the IRA or using it for my own interest? And that's the issue, right? I'm using my IRA in that example to secure a job. Okay, and then F, another one, you're basically dealing with the IRA to benefit yourself indirectly. So Joe uses IRA to loan money to a company, which he manages and control, but owns a small interest in. Same idea, right? Is the IRA being used exclusively to benefit the IRA, or is there some self-dealing reason? Okay, so again, in a nutshell, if there's no disqualified person on the other side of the deal, you can do it. Buying stock, you invest in a private equity fund, your family or you not involved, you buy Bitcoin, you buy gold, you lend someone money, you invest in a private business, you invest in a mutual fund, an ETF, a stock, totally fine, no problem. But if you're dealing with closely held transactions and there's a disqualified person on the other end of the transaction, whether it's you, parent, child, spouse, daughter-in-law, son-in-law, an entity you own 50% or even less based off the facts and circumstances, remember Rollins, think about it. The transaction could be at risk. If the IRS catches you, they can blow up your IRA on the date the transaction occurred. Tax, 10% penalty, even excise taxes, and get ugly. Okay, so it's important to do that analysis. If there's no disqualified person on the other end, you're good. If there is, then you got to look at the facts and circumstances. Yes, I can buy Apple stock and so can my IRA. There's 100 billion or whatever shareholders, not a problem. But let's say I had a company with 3 partners. Can I invest? If it's just me, my IRA, and another person, well, depends, right? If the other person's going to own 99% and we're going to own 0.5% each, maybe. But if we're each going to own 33%, or if my IRA is going to own 20 and I'm going to own 40 or whatever it is, like it's so closely held, it's going to be hard to prove the IRA is doing the investment solely to benefit the IRA. Now, the facts could suggest otherwise, right? You have $20 million in the bank. You could do it personally, but you think it's a good deal for your IRA. Maybe. But again, anytime you transact with your IRA, you open the window up just enough to a potential IRS attack. The question is how open that window is. Is it just open slightly, or is it opened in a much bigger fashion? So that's always based off facts and circumstances. That's why I guess the lawyers make the big bucks, because someone needs to provide analysis. I've worked with a lot of lawyers in these settings for clients, and it's frustrating because the client's like, give me an answer. And unfortunately, there's no answer sometimes. No matter what you charge the client, no matter if you work at the largest law firm or the smallest, it's based off the facts and circumstances. It's based off what the IRS agent may feel, who the IRS agent is, and a bunch of other peripheral factors. So unfortunately, there's no clear answer. It's just the more you do with a disqualified person, the greater your risk is. So again, why you want to do real estate or other alts, it's all about doing what you want to do, deferral, compounding interest, diversification, hard assets, and that. Now, can you partner with your retirement account? Again, facts and circumstances. Apple stock versus, on the other spectrum, closely held business with yourself and your IRA, probably no good. Can your IRA be a partner in a law firm? No, right? It's not an individual, can't provide services. Could your IRA potentially get an interest in a SPAC, right? Founders stock in a company, maybe a carried interest in a hedge fund or private equity, potentially, based off facts and circumstances. In some extremes, yes. In other extremes, no. So it's hard to give a general answer based off 4975, see whether something's allowed or not. It's always based off facts and circumstances. I know it's kind of lawyer talk, but it's true, right? You probably deal with this in your practice, right? It's hard to just give a client a direct answer. There's different factors, whether it's what the jury thinks or what a judge thinks or what the document says or what our strategy is or what this case law says versus what this other ruling says. So there's always just different factors to take into account. And the same with IRAs, 401ks, prohibited transactions, investments. There's a lot of gray area. One last thing I want to talk about in the next 5 or so minutes is a 4-letter word, UBTI, UDFI, unrelated business taxable income. So you guys may have heard of unrelated business taxable income. If you do work for charities, it's a big, big topic. Unrelated business taxable income is a way to tax charities, 501 exempts, right? Anything that is unrelated to the charity's exempt purpose potentially could be subject to a tax. And the tax is at the trust tax rates, which are relatively high, 37%, the very low threshold. So you reach that pretty much at like 20, 25,000 of income. Why do we care about UBTI and retirement accounts? Well, IRAs and 401ks, believe it or not, are treated as 501 trusts, right? They're tax exempt. They're not charities. They don't act in a sense as a charity, but they're taxed as charities. They don't pay tax. So when you look at the history of UBTI going back into its formation and codification, the intent was, listen, we don't want companies to set up charities and run their business through charities. Example, McDonald's, right? Imagine if McDonald's just set up a charity and ran their restaurants through charities. No one would ever pay tax. So they said, listen, if you're a charity, whatever you earn from that charity is exempt from tax. But if you have unrelated activities, if you're a hospital and you have a gift shop or a parking lot, you got to pay tax on that income. That is unrelated to your exempt purpose. Hospitals' purpose is to care for people and help sick people, not to sell People magazine or sell gum. So what do hospitals do? They just outsource it. You get rent and they get around that. But in some cases, you can't get around that, and charities pay unrelated business taxable income tax. Well, IRAs don't have an exempt purpose. That's the issue, right? What's your exempt purpose? Well, IRAs can invest in almost anything. So there's no exempt purpose. Now, UBTI really doesn't kick in most investments. Again, 96, 97% of retirement accounts are invested in passive investments like stocks or mutual funds or ETFs or bonds, right? Interest, royalties, capital gain, dividends, rental income. Those are passive. They're not business income. That will not be subject to UBIT. Okay, so that's why 97% of Americans never heard of UBIT, even though they may have a retirement account, won't kick in. UBTI will kick in three ways, three general ways. Number one, use margin to buy stock. So if you are trading on margin in your IRA, you may have UBIT. Why? A margin's a loan. The IRS feels that that is not passive. You're doing something active, and you will pay UBTI tax on a percentage of income attributable to your margin. Now, if you have to personally guarantee that margin, remember the prohibited transaction rules, can't do it. So you have to find a margin account where there's no personal guarantee. You can't pay. They make you sell your securities and your brokerage account to cover the margin. I have some clients doing it. It's possible, but beware of UBTI. Okay, that tax can kill you, right? 37% tax on a percentage of the gains attributable to the margin. So if you're using 40% margin, 40% of the gains could be potentially subject to UBIT. That's number one. Number two, use a non-recourse loan to buy real estate. Remember I told you non-recourse loan. You cannot use a regular mortgage to buy real estate. Why? Regular mortgage will violate 4975. You can't personally guarantee an obligation of your IRA. So if you get a non-recourse loan, which you can, it's possible. However, if you do it in an IRA, you're going to pay unrelated business taxable income on the portion of the income attributable to the loan. So if you put 100 grand in, you borrow 100 grand in a non-recourse loan, 50% of the net profits associated with that loan will be subject to the UBTI tax, 37%, which can go up. Trust tax rates. Yes, you can take into account your pro rata share deductions or depreciation, but the net amount will be subject to the UBTI.
If you're in a jurisdiction that requires a verification code, please write the following code word down. Play. P-L-A-Y. Play.
Third, you invest in an active trade or business like a restaurant through a pass-through entity like an LLC. You may say, whoa, I own companies from IRA. I own Tesla. I own GE. I own Peloton. What's the deal? They're companies. I'm investing in my IRA. Oh my God. Do I owe a UBTI? What is going on? No. Almost every public company is a corporation. C Corp. Think of it as a big box. C Corps box in their income. So there's no flow through of income. So there's no UBTI when you get dividends from a corporation. When you sell your stock, there is no UBTI because the corporation has its own tax rate. LLCs, partnership, think of it as a funnel. It's a flow through. All the income and gains flows through to your IRA. Because it's not an entity separated from its members, it does not pay its own entity level tax. The UBTI applies, unfortunately, to the flow through of income from a business. So if your IRA invests in a business, whether it's a consulting business, manufacturing business, restaurant, bar, whatever, store, and there's more than $1,000 of net income, you're going to have to pay UBTI tax on the net income. File a 990T, that's where you will pay your UBTI tax. Your IRA pays it, not you, but it's there. Okay, so that's something to be careful about if you're investing your IRA in MLPs, master limited partnerships. You're investing your IRA in potentially private equity. If the portfolio companies are not corporations, or even venture capital, if the portfolio companies are not entities. If your friend or neighbor wants you to invest in their restaurant or store and it's an LLC, be cautious because the UBTI is an ugly four-letter word that can really wreak havoc and turn a very favorable investment into a very tax unfriendly investment. One last thing on this. Talked about non-recourse loan in real estate. Remember I said under 514C9, if you use your IRA to invest in a real estate and you're using a non-recourse loan to buy real estate, you're going to be subject with this UBTI or unrelated debt finance income tax, which is the UBTI tax. However, there's an exemption for 401ks. If you have a 401k, a solo K, not a SEP IRA, not a simple IRA, not a Roth IRA, not a traditional IRA, but you're 401k or a solo K, and you're using the loan for real estate acquisition indebtedness to buy something, real estate, not to buy stocks, not to buy Bitcoin, but to buy real estate, there is an exemption around this UBTI tax. So that means you can leverage up an asset in a 401k and not pay this UBTI tax where you would in an IRA. That's another advantage of the solo K over the SEP IRA is you can leverage up an asset for real estate acquisition indebtedness and not pay this UBTI tax, which would apply to IRAs. So that's kind of it in a nutshell. You can do anything you want in an IRA or 401k except life insurance, collectibles, and self-dealing. Tons of really cool stuff you can do. Obviously, most of us will invest our IRAs in stocks, ETFs, mutual funds, but there are a growing number of us that want to do alternative assets, like buying the house next door, buying an Airbnb, buying gold, buying cryptos, buying private equity, hedge funds, venture capital, doing hard money loans, tax liens, tax deeds. There's lots of cool stuff you can do. Okay, and the whole point of this presentation was, number one, to educate people about the IRS rules. You got to know the foundation of the rules before you play, right? It's like you know how to play baseball, 9 innings, 3 outs, 3 strikes, 4 balls. You got to know how the IRAs work. Pre-tax IRAs, tax deduction, pay tax over 59.5. Take it out too early, tax 10% penalty. Hit 72, RMDs. Income limitations potentially if you make too much money. Roth IRAs, no tax deduction. Over 59.5, Roth's been open at least 5 years, no tax, take the money out prematurely, tax, 10% penalty, contributions can be taken out anytime, no RMDs, simple SEP IRAs set up by businesses, SEP IRA is a profit sharing plan, 20 or 25%, simple IRA, $13,000 for dollar, 16, you get the catch up if you're over 50, and you also have the ability to be flexible in investments. Solo 401k, better plan if you're self-employed, no employees over 1,000 hours other than owners or spouses of owners. You get the loan feature, high contributions, profit sharing, plus the 19.5 or 26,000 employee deferral for 2021. And then investment rules, obviously, life insurance, no collectibles, watch out for 49.75. Don't do anything with a disqualified person that directly or indirectly benefits. And then ultimately, remember that 4-letter word, UBTI, if you're doing 3 things, margin to buy stock, non-recourse loan to buy real estate in an IRA, or you're investing in an active trader business in a pass-through entity like an LLC or partnership, beware. UBTI can really impact you negatively. So again, alter no longer alternative. There's some really, again, very interesting stuff. Obviously, cryptos have been crazy busy. You can buy cryptos in an IRA, for example, with IRA Financial. You can own it in the name of your IRA on Gemini. We have a partnership with them. Super easy. You control the cryptos. You buy them. Again, I'm not advocating anyone to buy cryptos. I'm not giving anyone investment advice to buy real estate or to buy stocks or mutual funds. It's not my job as a tax lawyer. I simply want to educate people about the power of the retirement system, explain how simple really it is, and then obviously educate people about some of the really cool investment opportunities. And it's not just, hey, you can supercharge your returns if you buy Ethereum with your IRA. It's like, no, hey, some people out there really don't understand Wall Street. Some people out there really don't trust Wall Street. So I believe that if you believe in what you're investing in and understand it and feel more comfortable with it, you're going to be a better investor. So I'm here to say that, hey, there are opportunities and there are options the IRS allows you to do. And really, my goal is to just say, hey, it doesn't matter what you want to do, just know what your rights are, know what your options are. There's a reason the IRS wanted you the right and option to buy alternative assets, because it is important to diversify. And there are people out there that can do better if they buy real estate with their IRA. Maybe you're a real estate lawyer, you know, on deals with your clients are doing really well, you'd love to jump in, whether there's a house next door that you think is a great opportunity that you want to buy and rent out, or an Airbnb. Again, you can't use the house personally, right? You can't have any personal benefit, but you can rent it out, get the cash flow, the rental income. It's a hard asset. Hopefully you get some appreciation, and it's just a diversification play. So there you go. That's, in a nutshell, all you really need to know about IRAs. I pretty much, kind of went into the details. I went into the weeds. It doesn't get much more difficult than what I just talked about. So last hour, 20 or so minutes, it's everything you need. If you really, paid attention, hopefully I didn't bore you guys, put you to sleep. But if you really were able to pay attention, you should know everything you need to know. You should be motivated to save in an IRA or Roth or a SEP or Simple or a 401k. And hopefully you're interested in learning about different investment options and trying to figure out how you can best save for retirement. And there you go. If you have questions, you want to contact me, my contact information's available. I'd love to hear from anyone with questions or comments. And thank you so much for watching, listening, and take care.